Welcome, welcome. I am a minute late. I am so sorry. I was jamming along and looked up and I'm like, oh, garbage. I'm supposed to be in a webinar. So I'm here. You're here. Welcome. I'm going to share my screen here in a moment. Let's let people filter in. Appreciate you being here. Happy Wednesday, September 17th. And let's get jamming. All right. Nope, wrong screen. I think the chat is still disabled. I apologize for that. We might be switching up the platform here shortly. Technology is the bane of my freaking existence. All right. So, thanks for being here. We are going to launch in because we're starting a minute or so behind, and I want to be respectful of your time. If you have any questions, put them in the Q&A, and let's go. All right. Share my screen. Open Sesame. Well, bam. Welcome to the free weekly tax strategy workshop hosted by Make Taxes Fair. Our whole mission is to do exactly that, make taxes fair. We're giving you a warm welcome for today's presentation of the One Big Beautiful Bill Act, or what we fondly call OB3. This law was signed into law July 4th, 2025 this year. And these are tax law changes and what they mean for business. That's our whole intention today for today's agenda. We're going to be hitting the new law, highlight a business impact. How do these laws fit into what we call the clear edge framework? And the clear edge framework is tax credits, legal structure, employees, accumulation of wealth, retirement planning, exit planning, deduction optimization, getting organized, and at the end of the day, obtaining efficiency. Today, we're going to be hitting on some credits, legal structure, some employee benefits, deduction optimization, and a little bit of exit planning. So, kind of all over the place on how the OB3, and I call it OB3 because I'm a Star Wars fan, and I don't know, sounds like C3PO or R2D2. I'm a nerd. So, let's go with OB3. Keeps it one big, beautiful bill act. That's a lot. That's a mouthful. So, let's get into this. The One Big Beautiful Bill Act, there's tons. We're only highlighting a few. Tons of business provisions, tons of personal. There's some international law, high-level publicly traded company stuff, quite a bit. We're focusing today on business provisions and primarily focused on small business. And I hate the term small business, but small business meaning smaller in size. It's an economic measurement of business size, but nothing small about being a business. So let's talk about bonus depreciation, right? That was one of the big, hey, bonus depreciation is back. Cool. What does that even mean? So before we get to that, what is depreciation? Let's talk about that briefly. IRS publication 946 says, here's how you depreciate property. That's literally the title of the publication, How to Depreciate Property. So depreciation is the reduction in value over time. So think wear and tear, right? It's allocating the cost of the asset over a period of time or its useful life. So an example is a desk is a 7-year asset. The IRS says, hey, you buy a desk, let's say you spend 700 bucks on that desk. Well, that desk is going to last longer than a year. So 7 years over a straight line, if you were to equally take the asset and say spread it out over 7 years, straight line depreciation would be 100 bucks per year. That's the normal asset treatment. That's what you depreciate over the useful life, whatever that is, right? As defined by the IRS. So bonus depreciation is you take 100% of the cost in year one. Well, what changed with the OB3 or the One Big Beautiful Bill is bonus depreciation was restored. It was set to provision or sunset out. So previously, if you bought an asset, so let's say you spent 1,000 bucks on something in 2022, well, bonus depreciation, you were able to take 100%. 2023, 1,000 bucks spent, you were able to deduct 80%, so $800. 2024, 60%. 2025, where we were before the July 4th signing of the One Big Beautiful Bill, right? We were only allowed to deduct 40% as bonus depreciation. Into 26 and 27 would have dropped to 20% and 0%. Well, now it's been brought back and now it's made permanent. What does permanent mean when you talk about taxes? Like death and taxes, right? Well, permanent means that there's no sunset clause. So temporary, it was temporary before because bonus depreciation was set to sunset in 2027 down to 0%. So when it's made permanent, now it's not set to expire until the Congress critters, men and women of Congress say, hey, we're gonna do away with it, right? Here's the weird thing. It's only effective after January 19th. Congress, they smoke something, they get together. Who knows why they come up with what they come up with? Where did they come up with January 19th? I have no clue. If you could tell me, then you're much wiser than I am. But January 19th is the cutoff date. So if you spent $1,000 on something January 19th, you were only allowed to bonus depreciation of 40% or $400. If you bought that same thing, hey, January 20th, well, magically now you can take 100% or the full $1,000 as bonus depreciation. So just keep that in mind, right? January 19th and before, 40%, January 20th and beyond, uh, the full 100% is eligible for bonus depreciation. So, what are our opportunities with bonus depreciation, right? Well, now we have the ability to accelerate asset purchases. If you need equipment, machinery, vehicles, purchasing them now can give you a large deduction for the 2025 tax year, whereas before it necessarily may not have. So, if you're looking to bump into a higher bracket, it's wise to kind of say, hey, do I need to buy the asset? One, is it a need? And then two, do I expect to increase my income next year and the year after and the year after? Depreciation, as well as things where I actually don't like depreciation as a tax planning tool, as a tax mitigation, because you're robbing the future. You're saying, hey, I'm going to take the deduction now, rob the future of those deductions, which can harm your future tax bills, right? So I like to look at depreciation last, even though I'm presenting it first, but that's a hot topic in the OB3, so people want to kind of hear about it. Entity, reviewing your entity structure, figuring out, hey, what are my income sources? Are they passive? Are they active? How's depreciation factoring into those, right? If I have passive income and I'm using depreciation to offset that passive income to possibly create a loss, is that passive income or that passive loss going to be allowed? There are some rules around that. So you just want to be aware of, hey, how is this going to affect me? Strategically managing your income, taxable income. Again, if you have a business that fluctuates year over year and hey, I know this is going to be a peak year, um, bonus depreciation can make a lot of sense. So, helping manage that. Evaluating Section 179 versus bonus depreciation, right? Um, you can sometimes 179 gives you there are limitations with 179 where there's not with bonus depreciation, and not all states recognize bonus depreciation where some states do or will recognize 179. So you may say, hey, maybe I want to counterbalance this or play the game of take more or less depending on those circumstances, right? Planning for future asset sales. So let's say you buy something for 100 grand, or I had a client, they bought a $250,000 server. They were in the IT space and they bought this, $250,000 server, took huge depreciation, but wrote the whole thing off with between 179 and bonus depreciation. But then they sold that asset 2 or 3 years later. So, they had a zero basis. So they wrote the whole thing off and had zero basis, and then they sold it for 100 grand, so they had to recognize $100,000 gain on the asset. So, if you're looking to sell assets in the future, rather than just, hey, it's worthless and we're going to dispose of it for salvage value, so to speak, that you want to consider that as well. So be thoughtful about how you use that. And again, coordinating with state tax rules, looking for estate and succession planning. If I'm going to sell the business, same thing goes with selling assets. You want to be aware of that. And then looking at, hey, is there cost segregation? If that applies to a lot of real estate type investors or people that are real estate professionals that are exempt from the passive rules, right? So waiting the full 27 and a half years or 39 years to benefit from depreciation may or may not make sense. You can accelerate that with a cost segregation. So the question is, does depreciation impact your taxes? And if you are not aware, if you're not part of our maketaxesfair.com/community, you should be. So maketaxesfair.com/community is where you can go right here. And we are going to put inside of the community, this is where you can go ask questions. This is completely free if you're a business owner. We don't always put the full resources, full workbooks, everything into the community that's free, but this time we are. We also have a VIP community where you can go to get access. Normally, in cases like this, where we have a workbook, we put the workbook inside of the VIP community. This workbook today, we are putting in the free community. So join Make Taxes Fair .com/community is where you can go to join the free community and get the workbook. We will be posting that up in this in the community after this recording renders and everything. Cool. All right, let's talk about QBI or qualified business income deduction. So, what the heck is QBI? Well, imagine you ran a lemonade stand, right? Keeping it super simple. And at the end of the summer, you made $1,000 in profit. Sweet. Government says, hey, you're running your own business. Well, we're going to give you a break. We're going to pretend like you only made $800 instead of 1,000. So you're only going to pay taxes on the $800. That's essentially what the QBI, it basically gives you a 20% discount on your taxes, like what your income sort of reduces your taxable income by 20%. So it's like, hey, I got a coupon of 20% off my income to pay less in taxes. Who doesn't like that, right? Who would not want a 20% discount on your taxable income? That is the Section 199A. So what the OB3 or the One Big Beautiful Bill made changes to this is now the Section 199 or QBI is permanent. Before it was set to expire, but now it has been made permanent. There are phase out limitations. We'll talk about that in a minute, but there are phase out thresholds. And what that means is your QBI deduction is lost as your income increases. They expanded those phase out limitations. There were no impact to business type, and I'll explain what that is. So a specified service, trade, or business rule applies. There are no changes to this. So what in the world is a specified service, trade, or business? Say that three times fast. That's a tongue twister. An SSTB is a service-based business that relies majority on the skill or reputation of the owner or one person, right? So healthcare, doctors, dentists, chiropractors, etc., that are self-employed, law and accounting, right? Attorneys, legal consultants, CPAs, and accountants. So that's me. Uh, Consultants, financial services. These are some examples of businesses where the driver of the business is the reputation or skill of effectively one person. Like all this is knowledge, think knowledge based businesses. So relies on the skill or reputation of one person. So your QBI deduction, it will decrease as your income increases. And what happens is if you're single, you can get the full deduction, full 20% deduction of up to basically 200,000, 197 and $300 of income. If you're married filing jointly, you effectively doubles, right? You can earn your income can be up to $394,300 and still qualify for the full 20% deduction, whether or not you're a specified service, trade, or business or not. Well, the phase outs start to occur. You start to lose when your income is over that 197 or that $394,000 mark, and you completely lose the deduction when you are over 272 or 544 in those numbers, right? So classic government, right? They penalize you if they give you a reward, they give you an incentive to go out and make more money, but if you do too good, they take it away. Yeah, so you got to be aware of that. But If you're one of those specified service trade or businesses, you get no deduction if your income is over that limitation. And if you're a non-service trader business, you're still eligible if you're over those limits if these criteria apply. 50% of your income is paid out in W-2 wage. I'll dissect that in a moment. Or 25% of your income is W-2 wage and 2.5% of UBIA qualified property. So what the heck does that mean? So 50% of W-2 wage test is this. Let's say if your income is over the threshold of 360, or that top threshold for married couples, and you earn, let's say your business earns $200,000 in profit. So you have other income, your spouse works or other businesses, right? So you have $200,000 in profit. And if your business only paid $40,000 in wages, 200,000, 40,000, right? You only qualify for up to $20,000 in QBI deduction, whereas your normal deduction on $200,000 would have been 40,000, right? So your QBI deduction is throttled to be 50% of what you pay out in wages. So the more wages, W-2 wages you pay, both to yourself as an owner, if you're an S corp, or uh, if you're an S corp, or to your employees, the more wages you pay, uh, tongue-tied today, then that gives you the ability to capture more of the QBI deduction or the maximum deduction. If if your income and W-2 wages are lower than that, you can still qualify if 25% of your business is revenues paid out in W-2 wage and 2.5% of the original cost of your depreciable property, so buildings, equipment, machinery. So that it's a more complicated formula, but it increases your cap when we factor in 2.5% of your total assets. And what the point is here, the government's trying to incentivize people to, hey, you're not paying out W-2 wages. Well, are you investing heavily in equipment, stimulating the economy, right? So a lot of real estate investors or uh, a, a capital equipment heavy business types can benefit from that and still capture the QBI deduction. So QBI is an opportunity with it being made permanent. It's a good opportunity for you to revisit your entity structure to look at, hey, can I smooth out some of my income with higher phase outs? Like, we have a guy who we're looking at establishing a C corp and leveraging a multi entity strategy to legitimately transfer income from one entity to the other to make him QBI eligible potentially again. Coordinating with bonus depreciation in Section 179, those bonus depreciation and the depreciation we talked about earlier impact the QBI deduction. And then adjusting your estimated payments, right? If we were looking at, hey, QBI was expiring, maybe your estimated payments were based off of it being expired for 2025 and beyond, but now it's permanent. So, hey, we get that now. So if you did not know about the QBI, or if you knew about it but learned something new today, we went through it fairly quickly. Grab the workbook. Again, you can get that in the maketaxesfair.com/community. That's where you can go to learn about the what we do in Make Taxes Fair. But we're posting this webinar. We're going to post the replay and the workbook in the free community. Normally, the workbook only is put into the VIP community, but in this case, we're going to put this one because it's OB3, and we want to make sure that folks are aware and know about this. So thanks for being here, and we're going to keep jamming along. Let me check the Q&A. I think the chat, again, is unfortunately disabled. I hate technology. Let me see. No questions. Okay. So Section 1202, qualified small business stock exclusion. Guys, gals, this is going to blow your mother freaking minds. I think this is crazy. So, Section 1202 is if you have investment in a small business and there are criteria, but you can get a tax-free exit up to $15 million. Tax-free. Wild. I've had several conversations over the past little bit with some folks that did not know about this, and they're like, "Wow, that's really changing how I'm going to approach some future business plans," right? So here's the criteria for this. You have to be a C corp. Ew, we don't like C corps. Double taxation. Well, maybe. They're a tool that can be used in the right circumstances, and this could be a justification for that. You have to be an eligible shareholder and you have to have the right holding period. So what does that mean? You have to be a C corporation from inception. You have to be a C corp, not an LLC. So if you created an LLC and then made the S election, you're toast. You have to be a C corporation. Um, your gross asset limit, it was raised from 50 million to 75 million. So the legal structure and the asset type kind of came into play. You have to be an eligible shareholder. You have to be an individual. Trust and estate can qualify. I did not put it on a slide. S Corp, LLC. If you have an S Corp or an LLC, may be able to qualify to have your S Corp own shares in the C Corp. Maybe. There's some pretty restrictive criteria there, but it's a possibility. So that could be impact. But you have to be an original issuance shareholder. So what does that mean? It means that on the first round of stock, you were one of the original shareholders, right? So you have to be an eligible shareholder. There's more criteria in the workbook. We'll get to that. So the holding period, it used to be that if you held onto this for 5 years, you could get exit tax free again up to 10 million. Now, if you hold on to the stock, if you own this corporation, the stock for 3 years and then exit, 50% capital gain exclusion. 4 years, they did a ladder effect. If you own it for 4 years, 75% capital gain exclusion. And 5 years holding on to the company, 5 years, you can exit 100% tax free. Wow. Wow. Right? So the opportunity here is long-term exit planning, right? To evaluate, is there, hey, what are my exit plans and when do I plan to exit this? Deferring equity grants investing, right? You can I had a client years ago who was an employee of Roku, right? The device, the streaming device little thing, before Apple TV and all that came out. He knows about Roku, right? He was one of the original employees and was granted stock options, and they were a Section 1202 company. So he hang on to his shares, and when they went public, his shares have increased, but his equity in the company, because he was over 5 years, was 100% tax free. He's worth like 4 million bucks. Like the guy was, and he was like, yeah, yeah, I'll sell him eventually. I don't know if he ever did. I haven't worked with him for a few years, but wild, absolutely wild. Leveraging the multi-taxpayer play, right? This is where if you have family or you start a company, husband, wife, partner, spreading that capital gain out through, looking at the structure and the legal structure. So that's important. Kind of all this is interconnected to say what is our legal structure and is there room for this strategy? Are we building and going to exit these things in the next 3, 4, 5 years, right? Because there's tax-free exit. So auditing your qualified small business stock eligibility to Section 1202 eligibility criteria is really making sure you thoroughly understand that and then understanding like, hey, are there state conformity issues? Like, are, California, New York, wherever you're at, does your state recognize the Section 1202, or are you going to end up paying state tax? Well, the juice could still be worth the squeeze, or making sure that you avoid clawbacks by running afoul of the rules and saying, hey, that what I thought was going to be a tax-free exit ends up being not because I ran afoul of the rules, right? So I'm guessing because not many people know about this strategy. If you did not know about this, check out the workbook. Again, go to the maketaxesfair.com free tax strategy community because we're going to make a post, put it in there, and put the playbook, the workbook in there in the free community. Again, normally we only put the workbook in the VIP community. This we feel is relevant. People need to know about the OB3. So we're putting it in the free community as well as the VIP, the paid community. All right, research and development. So what is R&D, right? Activities aimed at innovation, development, improvement of products, process, formula, software, inventions. Some of the industries that can qualify: manufacturing, software, tech, biotech, construction, food production. What is R&D? Four criteria the IRS uses, a four-part test. Permitted use. So what does that mean? The work you're doing must be intended to create or improve product, process, technique, software, invention. But people don't realize it doesn't just have to be revolutionary, it has to be technical. We're talking about, are we making this thing more functional? Are we solving a technical problem to improve performance, quality, reliability? Right? It's got to be technical. So if you're doing these things and experimenting in with materials, tools, you could be in the zone, right? You could be in the zone for R&D. Has to be technological in nature. So in hard science, engineering, computer science, physics, chemistry, biology. If you're solving problems around sales processes or marketing processes or HR, human resources, I'm sorry, those are solving problems, but that's not research and development. It has to be hard science. So software, running simulations or models, working on mechanical, material, formula, technical space design, science or technology, right? So you got to be employing technology, systems, or engineering methods. The elimination of uncertainty is a third test, and this one's all about problem solving. So are you eliminating resolving technical uncertainty, meaning you don't know for sure if you're going to get the result, right? Or you weren't certain if it could even be done, or you have multiple ways to do it and did not know which path would yield the best results. That is technical uncertainty. So, like, will the material meet the stress test? Can we get this app to run faster using a different database structure? Are there more efficient ways to manufacture this part or this process? You had to figure something out, and then through trial and error, you're eliminating uncertainty. So, if uncertainty is what drives innovation, and it also opens the door for the credits. So, you have to have the uncertainty. The fourth and final test is the process of experimentation. And that's where the IRS wants to see you didn't just guess or wing it, right? You actually have a systematic approach, a scientific method to test, model, prototype, simulate, trying version A, B, C. Doesn't have to be fancy, it just has to be intentional. And the experiment doesn't have to succeed. In fact, if you have a 100% success rate, they're going to say, well, that's cool. How are you uncertain that that was going to work? If every single one of your tests was 100% successful, was there a elimination of uncertainty? Probably not. So again, scientific method. This is kind of what the IRS wants to see. There are a lot of people that are like, well, research and development, I flew down to San Diego to kind of look and develop new business down there. That counts as R&D. That's cool. No, it does not. That does not meet the definition of true R&D, right? So what are qualifying expenses? Wages of technical employees, engineers, uh, computer science programmers, right? Supplies used in R&D if you're testing a physical product or a physical process. Contract research. So you can say, hey, we're contracting with another company, but the key there is an outsource. The key there, pardon me. Oh, taxes are boring. Wow, man, got to keep people awake. So contract research could be outsourced, but it has to be US based company. It can't be, hey, I'm contracting with somebody in the Philippines or India or Iran. There's some really bright people in those other parts of the world, but I'm sorry, there anything you spend on outsource has to be US based, right? Cloud software development costs, all these things. So what changed with R&D with the OB3? Well, update number one is before the OB3 or the one big beautiful bill, R&D had to be amortized over 5 years, meaning you had to take the cost of R&D and spread it out over 5 years. Now they allow for immediate expensing. Um, in essence, they were viewing it as a capital asset that the life of that R&D was going to last longer than 1 year. So now it's allowed immediate expensing retroactive to 2023. So there are folks that are starting to evaluate, hey, should we go back and amend the prior year tax returns? The tax credit is a payroll tax credit and up to $500,000. So the credit has increased from 500,000 up to 750,000. And there's been expanded eligibility as far as early stage companies and such that can take advantage of this, right? Before the R&D was fairly restricted, now it's been expanded to include more software development, AI experimentation with some streamlined compliance rules for small businesses, right? Trying to make it easier for people to qualify. So R&D. First step is you for opportunities for tax planning here, evaluate, do you have anything that does qualify for R&D? So grab the workbook, work through this and say, is there anything in our process or can we qualify for R&D? And then, or is there an opportunity to say, hey, if we were doing R&D, and we had to capitalize it in the past, can we go back to expensing it in full? File retroactive claims if eligible for that. Revisit your cost tracking methods and say, are we fully tracking all of these costs and all these things? And then coordinate those with the R&D tax credits. Say, should we deduct it? Should we claim the credit? Like, what's the best bang for our buck? Or is there future development? If you're not doing anything right now with R&D, but now you're like, oh, well, shucky darn, I could be. Maybe I should be doing something like that and applying this this knowledge to future development of software tech products, that type of thing. And then always monitor and be careful to be aware of state conformity, states that may or may not conform, and how that impacts the net tax result. So if you didn't know about R&D, grab it, or if you did and you learned something, grab the workbook. Can R&D apply to your business? You should be taking a hard look at that to say, does it now? If the answer is not, then how could it? Now that I know a little bit about that, is there an opportunity to kind of expand in that area? Right. Other questions, state and local. So, state and local tax or SALT cap increased across the board. And what that means is income tax, sales tax, property tax. Previously, it was all capped at $10,000 annually. Now that has been raised to $40,000 annually, and there are adjustments for inflation starting in 2026. This is not a permanent extension. This is a temporary. It is set to revert back after 2029 to the $10,000 limit unless the congressmen and women critters, as I call them, decide to do something different. So evaluate your SALT expense. Is this going to impact your taxes? Is that increase? Maximizing timing, maybe prepaying some expenses, property taxes and such can push you over the limit to benefit you. The PTE or pass-through entity tax strategy has been deployed for several of our clients, and we like that strategy. But evaluating, is that still going to work, or is that going to yield better results for my business than just paying it on the personal? Even though the increase happened, should you can revert back to claiming it all on your personal tax return, or should you continue to use the PTE, right? So, and then obviously looking for, again, the state conformity issue, that is always a issue. So if the SALT strategy was not on your radar, you weren't aware of that, grab the workbook, put the knowledge into power. It's going to be in the free community. So tag this as a place, say, I need to go into the community and download that when it's available here in the next hour, right? The tax rates were preserved. So I'm going to go through this fairly quickly. The OB3 extended and improved the 2017 Tax Cuts and Job Act in many ways, and the tax rates were a huge part of that. So in 2017, the tax rates used to be 10, 15, 25, 28%, 33%, 35%, all the way up to 39.6%. The new rates dropped, 10% rate didn't change, but 15 went to 12, 25 went to 22, 28 went to 24%, 33 went to 32%, the 35% bracket remained the same, and then the 39.6 dropped to 37%. So across the board, you can see lower rates mean less taxes paid for most folks. And with the OB3, those tax rates are now permanent, right? They were set to expire. So what this gives us the opportunity is to better forecast income by bracket because now they're permanent. We don't anticipate them changing for a while. We can do better tax planning for a longer period of time. Accelerate income. There may be reasons to say, hey, I want to accelerate income rather than defer income, because we again have more income in lower brackets. If some folks that were aware that these were going to expire, unless they were extended like they were, they may have deferred income. So now it's the opportunity to say, let's accelerate that potentially. Fine-tuning your reasonable compensation if you're an S corporation owner, can make a lot of sense. Say, hey, let's make sure we're paying the right amount of salary that's reasonable and justifiable, and then take advantage of lower brackets. Fringe benefits. These are great ways to reduce your fringe benefits are some of the most underused tax strategies for business owners, especially S Corp and LLC owners. So, what's your plan for leveraging the new lower tax brackets? Check it out in the workbook and grab it there. We're going to close this out today with something called Trump accounts for kids. So, like them, love them, or hate them. They nickname them the Trump accounts. Don't want to get political. At the end of the day, these things, that's what they're called. They're called the Trump accounts. So, what these are is tax advantaged Head Start for minors, right? They're a new type of account for minors that gives a financial head start with tax deferred growth. If your kiddo is born in 25, 26, 27, or 28, well, the government says, hey, $1,000 seed deposit for your kids if they're born in those years, right? Awesome. But what if your kid was not born in 25, 28, right? And let's talk about this. So a lot of folks are like, well, I could just open up a retirement account for my kid, my 3-year-old or 4-year-old, because they are a model for me in my business. Hiring your kids in your business, and this is a whole separate topic that we're not going to address in full here, but the court tested age to hire your kid in your business is the age of 7. That's the court tested age. So, unfortunately, and the exceptions are rare, that if you have a kid under the age of 7, we're probably not going to be able to hire them into your business. So, it means you can't pay them a W-2 wage. They have to have earned income to be able to contribute to like a Roth or an IRA account. So, that strategy is really off the table for the vast majority of folks that child is under the age of 7. What the Trump account does is it gives us the ability to open up an account for a kid under the age of 18 that has a social. Contributions can start July 4th, 2026. So this is a next year thing. Wanted to put it on your radar so you can start thinking about this. The maximum contribution is $5,000 per year, of which $2,500 a year can come from the parent's employer. Let me say that again. Half of the $5,000 contribution can come from the parent's employer with no earned income requirements. So if I have 2 kiddos, mine are 8 and 11. Well, they're on payroll and they're earning some amount of money in addition to what I pay them W-2 and claim the deduction against the business. Cool. And now they can contribute to a Roth IRA account. Cool. Now I can open up an account, a Trump account for them in 2026. And my company can pay up to $2,500 a year to each of my kids' accounts. You cannot discriminate. So if you have an employee that also has 2 kids, or if I'm number 2 of 7 kids. So if I have an employee that has 7 kids, hey, if I'm going to put 2,500 into my own kid's account, I also have to do the same for every child for the employer or the employee. You can limit, there's some restrictions. You can kind of structure that in a way that you don't break the bank. But that's awesome if I want to give my employee a raise or say, hey, I'm going to put money towards your kid. How does that work? So if I put $2,500 a year, only 2,500, remember you can put up to 5,000. But if I did that for 18 years and assumed an average rate of return for 18 years, I will put $45,000 in contributions into that Trump account for that kid, meaning, hey, with 9% growth, 18 years, the future value of that's going to be about $103,000. But from the age of 18 to 60, if nobody puts any additional money into that account, it's left untouched, the kid doesn't pull it out. At age 60, assuming an average rate of return of 9%, that 103,000 is going to grow to 3.8 million. dollars. And that's only with $2,500 a year of company contribution. That is massive. $3.8 million to create a legacy using your business for your child. And that's on top of any Roth IRA, any other strategies. That's mind-numbing, right? That's really mind-numbing to me that you can, through your business, create a legacy that lives well beyond you and your business for your kids. So I love this strategy. The mechanics and the eligibility is the funds have to be limited to a diversified US stock index fund, no withdrawals. You can't take the money out until the age of 18. You're penalized. There's information coming out around these things for the specific rules, but it's really designed to say set it, forget it, and just invest for the future, right? Pretty fantastic way to help create a lasting legacy for your kids or the kids of your employees. Amazing. So, your to do or action planning opportunity is adopt a policy for what you're going to contribute as a company, investigate, because again, this is July of next year. So, we have time to figure out, okay, where are we going to open up the account at and make the $2,500 contribution. So, if you didn't know about the Trump accounts, check it out. More information in the workbook and more information coming around this, right? At the end of the day, it's something that is more information is being released. There's still some things kind of being fleshed out around this and what it means and what it is. But something that's absolutely wild to me is this strategy and these strategies that we've shown you today, kind of deep diving a little bit on the one big beautiful bill. There are only one or a couple of dozens of tax strategies out there. The IRS does not want to teach you how to use the tax code to your advantage. And that, folks, is why we have things like our free community where the replay of this is put into there. If you're here and you're like, man, this is dope, I think my friend, if you have friends that are business owners, share this with them because friends don't let friends overpay the government. That's all we got for you today. We'll be posting the replay of this webinar into the school community along with the workbook that will be there shortly. So if you missed this or if you're catching this on the replay, download the workbook, check it out, share this free community with your friends. Friends don't let friends overpay government. Probably going to do in a few weeks, we're going to do an update on the OB3 to see if there's any new changes that are coming about or any additional information that's been released by the IRS. But I want to thank you for being here. I ended up doing back-to-back webinars today. So I've been now talking for almost 2 hours straight. I'm going to take a break and check for any Q&A. I think we're going to see if we can try to get the chat hands fixed for our next. We might be switching platforms here, but I appreciate you all being here. I see no additional questions. So thank you for your time. Thank you for being here. We're going to end this now. Say, if you can't be good, be careful. Visit us. Let's chat inside the boards and go from there. Thanks so much. Bye for now.